started, and if anybody hops on, they can catch up. So, first of all, thank everyone for being here and joining us today, especially in the evening. Appreciate that. For those of y'all that don't know me, I'm Brian Ferguson, Fergmar Capital, and I have some of my team on the call today. Braden Robinson, our VP of Ops, Clayton Garner, VP of Product Development, handles all of our underwriting. Bailey Koopman, who heads up and is the director of our asset management and property management division. So, today we're just going to talk through the Tanglewood deal. The team will kind of help us share some expertise and talk through some of these, answer any questions. As we go through it, there is a chat box on there, so just drop questions as you go. We may not answer them immediately when they come in, but we will definitely get to all questions before the webinar is over today. So, all right, well, so we're here today. We're talking about Tanglewood Apartments. It's a 104-unit Class C multifamily apartment complex here in Victoria, Texas, located at 306 Sam Houston Drive. This is just a general disclaimer, and we will share this slide with anyone that wants it afterwards. So a little overview on the deal. It's a value add opportunity, multifamily. Right now it's positioned at a C class. When we're done with it, we will be considered a B class. 104 units. It's in the Tanglewood neighborhood. We actually currently have almost roughly 200 units in that area already. So we will kind of bolt this onto those operations. Amazing factors. We're assuming a 4.49 fixed rate here from the seller. Few of the competitive advantages, things we like about it. It is a utility included model, which is great. Like I said, we own a few hundred units in that area, and the utility included model is just really nice when someone that's renting a $1,000 a month apartment, they don't have to go pay 4 or 5 other deposits at 50 or $100 a piece. So makes it very, very attractive for them, and just kind of separates us from some of the competition there as well. Like I mentioned above, we're assuming this 4.49% interest rate, just much lower than we can see in the market that we would get if we had to get new debt. And we're assuming that at 78%. So just for some that may not know, if we were to go get new debt on this, we'd probably see 70, maybe 75%, realistically about 70% LTV, and we'd see it probably in the sixes, and then we'd have some additional closing costs. So just great debt going in. Property overall, they did quite a bit of CapEx when they bought it in 2019. Some capital improvements, improved a lot of the interior units. Still quite a bit to do on the outside. Overall plan here is we'll buy it. We're going to stabilize it. It's a 10-year hold strategy, which is a little unique for us. If any of you on today or in some of our other deals, you know that. The purpose of the 10-year hold, just because the way we're acquiring it so far back of market value, it gives us a unique opportunity to where we're able to execute a refi at probably somewhere around year 4, into year 4 going into 5, and we'll return about 85% of investors' capital, plus distributions that are happening. So most of the money will be returned to the investors. We'll be locked into a new long-term debt, and at that point, we'd rather ride out the next 5 or 6 years. It's going to cash flow extremely well at that point. So, all right, this is a little bit about the investment summary. And again, I know there may be a few folks that are new on here, so if you have questions on any of this, what it is, there's no bad questions, good questions, just fire them away. This is a 506C, so it's for accredited investors. If you have questions on what that is, we can help. Minimal investment's $50,000. We're projecting a little over a 16% IRR, extremely strong equity multiple at a 2.83, average annual returns at above 18%. We're looking to close June 26th. With this being a loan assumption, there could be a little give or take in that. Our structure here is we've gone to just a really simple structure. We 80-20. There's not pref, there's not asset management fees. We just do a straight 80-20. It keeps us simple, keeps us very in line. The GP co-invest, so that just means as the GP, what are we putting in? We'll do a minimal of 10% in the deal. And then here's some just kind of projected cash flows, and you can see year one's our ramp up, shows at 3%. One interesting thing to note on that is we're actually projecting a lower NOI in year one than the current owners are doing. So with stronger management, we're conservatively saying we will project a lower NOI just turning some units. So there's a lot of opportunity for that to be better. And then we get into that 7.99 because we're still stabilizing through about month 18. And then as you can see, once we're stabilized, we hit double digits and just cash flow from there. At a certain point, all the money's returned and you're virtually infinite returns at that point. Just a little bit about us. Again, I think most people on the call know me. If they don't, we've been at this for almost 2 decades now. Started out flipping houses, moved into single family rental portfolio, built that up, got into multifamily, and now we're in multifamily and shopping centers throughout Texas. So a little bit about our team. Like I said, somewhere on the call today. I think we have Clayton on the call today, does a lot of our deal analysis, VP. I introduced Bailey, Braden, Brad Thompson, our director of construction. He's been on site at this property. Katrina Garner, she director of finance. She's been working on this heavily. And then Bull, our partner, one of our founders. As we sit today, we're 1,000 doors in our portfolio, about 110 plus assets under management. Plus, I'm passively invested and sit on the board for a handful of other companies throughout Texas on about another 60 million in assets. This is just a little bit of our history, where we started at 2007, fast forward to 2025, which kind of tells the history that we just talked about. Again, we'll share this slide for anyone who reads it in depth. This is our deal history. This is important. I think we like to share this, like I said, in 2 decades. This just gives a breakdown of, this isn't everything, but some of what we've done. We're approaching now, if you added everything to this, probably $500 million, if not more, in transactions over time. So we've done this, we've bought, we've exited. So operational and management is definitely our background here. Again, just a little bit more about our team. Now we'll jump into the property specifically. So this is just an overview of the apartments. Few things you'll see there. As you can see, new roofs on it. Owner that bought it in 2019, they did some new roofs, a lot of interior upgrades, as I mentioned. We have a huge plan for the exterior, and I'll get to that here in just a few minutes. A little bit more about it, if you want to get into the specifics. It was a 1973 built garden style. It sits on roughly 4 acres. Let's see, there's a washer and dryer connection in all the 2 bedrooms, which is great. This is a little mix of the floor plans here. One thing we really love about the floor plan mix is as you'll see, there's multiple 1 bedrooms, and then there's some 2 1s, and then a lot of 2 2s. The biggest mix, and you'll see on the rent roll coming up, is the 1 1s and the 2 2s, which in this particular area, there is a ton of 2 1s. They still rent, but they're the slowest to go. The 1 1s and 2 2s move the fastest, and we have more of those than we do the 2 1s. So it's really exciting mix up for that. We'll kind of jump into the property and just some specifics about interior and exterior here. Location wise, it is, minutes from the college, the new A&M University. For those who don't know, A&M's taking over U of H, will be one of, I believe, 13 A&M campuses. The proximity of this we feel it'll be really great. Obviously, since that hasn't happened in our underwriting, we're not factoring for any of that, but we do feel we'll see some upside in that. As we get into the property itself, kind of let Bailey Koopman jump in here. She's been on site countless hours doing due diligence, and let her just kind of talk through the good, the bad, the ugly, what we like, what we don't like, and spend a few minutes on that if you don't mind, Bailey.
Yeah, thanks for having me today. So we had touched a little bit on the location in regard to the units that we own in the area as well. Something that Brian had already highlighted, and what I feel is one of the most appealing of the property is that 1 bed, 1 bath floor plan. What is unique is you do have 2 different 1 bed, 1 bath unit types. So you have a smaller and a larger. With the all bills paid units, it really just appeals to a different demographic, like inside the market. Like you had said, we don't have anything inside the area that is offering all bills paid, and the only comp inside of the market that we actually have in Victoria is one other complex as well. So I think the competition is definitely there in order to kind of take over that part of the market inside of Victoria. Being on site, our due diligence is extremely detailed. We walk every unit. talk to almost every tenant if they're present, and really just get a feel for what the tenant base is, what is the demographic, what are they liking, and what are they not liking. Some things that we identified very early on in the due diligence process was just the amount of deferred maintenance on the property. We were able to identify that there was some like deteriorated exterior and interior items that need to be taken care of like right away. So our larger CapEx plan and kind of more detailed is to go in and just take care of any critical maintenance items to ensure that the property is keeping that resident satisfaction and making sure that we're upholding the standard for the communities that we currently manage inside of Victoria. One thing that we're looking to do is we'll give the property a total facelift. So we'll paint all exterior buildings. We will go through and remove all carports, parking lot striping, parking lot repairs. And then as far as interior upgrades, we're looking to really go in and match like existing upgrades. You had stated before that the owner previously had already done work inside the property, and that is the case. We feel like we can push a little harder on the market rates with the all units paid in regard to the work that's already been done, just matching that style. So the biggest kind of gap to close here is the outside of the property and taking care of anything that's critical maintenance wise. But other than that, I mean, it's a great layout, great area of town. We really feel like it's going to be, a perfect add to our portfolio. So.
Awesome. Thank you, Bailey.
Yeah.
And like she said, the exterior is, and if anyone local wanted to drive by, we actually own a smaller complex on the corner there that we is similar to this that we've turned. But with the amount of CapEx budget, we don't always have the luxury of, it doesn't make sense if you go in and everything's in great shape. Maybe it's not the best color, and so you want to maybe change some accent colors. You don't always get to give it that just fresh, that brand new, fresh feeling, and that's a huge advantage we'll have here. Is the insides are great. You can see in the bottom corner here this fitness facility, like just some things that they've done well. The outside's not one of the things that they've done well. Leasing office here as well, they've done a good job, but outside they just haven't done a great job on, and that's where we'll be able to take over and bring our skills. And it'll just give it a fresh new look. And when you can give that, I'm sure everyone's seen it. You drive through a neighborhood, that house, it gets completely remodeled. It just really changes things. So, talking a little bit on the back history there as we go through some more of these, and here's some more of the amenities as you'll see on the inside. Like I said, as you can see, it's for a 1970s property. They have some really nice interiors, there's tiled shower surrounds. They did a good job. It's one of the things they did a good job on. Before we get into location, and I'll kind of even back up here, just a little background. I think it's important to know to understand why we're understanding why we're getting such a discount on this. So current owner bought this in 2019. They bought the property. They went in, put the new roofs on, started turning interiors. They did a good job on all that, and then somewhere along the way, they just did not run operations properly. The gentleman that owns it, he's out of, I believe, Houston, North Houston, somewhere around there, and he hired some staff, and he has a decent staff on site, but he's managing it himself, and I wouldn't say just not being done properly. Like I said, that's where our 2 decades of management experience and operational experience is going to come into play. For instance, that fitness center, all that equipment is brand new from 19. It's never been touched. They never opened it to the residents simply because there's a door that connects it to the office. That door is a $500 fix. We'll have it done within days upon taking over, and the 104 people will now have a free fitness center. So it's just little things like that need to be done. And then there is a lot of lack of maintenance on the outside. So that being said, due to the maintenance on the outside, end of last year, so this is an agency loan with Fannie Mae. For those of you familiar, they come out and they do quarterly, biannual, just depends on the inspections. And they'll send you a list, whether it's trimming trees or repairing rotten wood, and they expect you to take care of it. It's agency loan. And the past few years, they've been a little bit more lenient, and it seems like as we're coming into the year and things have started to recover a little bit in the market, that they're not being as lenient. We're normally pretty good. We get a letter within 30 days, all the repairs are done, we send it back to them. They didn't do that, which caused a foreclosure sale to be posted. A lot of times you think that foreclosures are due to non-payment. That's not always the case. When you get into these agency loans on commercial and multifamily, if you don't adhere to the other things that you're supposed to do, like upkeep and fixing items upon inspection. So that's what happened here. foreclosure was posted, which allowed us to bring it in at the $6 million price point versus the $8 million market value. And just due to they're trying to get something versus nothing. And they knew our history, they knew what we had in the area, and we could get it closed. So anyway, just wanted to touch on that. So location, as you'll see here, Tanglewood's right here. The college, Victoria College is here. We still have it labeled University of Houston. We can't formally label that, but it will be the new A&M campus next to the medical center. So there's just a lot going on around here to draw to the complex and its location. Just a little bit more on the location snapshot we have here. As you can see, we're sitting right here. Dive into the finances and the business plan a little bit here. I won't go through every line, but if there's any questions on what we go over, or someone wants to see this in depth, please let us know. Some of this is a little redundant, we've already touched on, but we're going to do a lot of exterior wood rot, repaint, almost look like a new outside. As Bailey mentioned earlier, we're going to repair, replace, or remove carports. Most of the stairs and balconies are going to get completely replaced or redone. We will be doing a cost segregation. For those of you that are familiar with that, we'll do a cost segregation. So for the investors, there'll be a nice year one depreciation loss on your tax returns. And then operations, obviously, marketing strategy definitely needs to be pushed. Doesn't even say that utilities are included. So if that's a $200 delta on the rent, a $1,000 unit, you're comparing it to say someone, that's 900 down the road, but really it's including $200 worth of utilities. That makes that unit actually cheaper, but people don't know what they don't know. And if you don't tell them, there's no way they would know. So utility management systems, we have a pretty good one in place, and we'll bring that on all of our management systems and processes there. Preventative maintenance is definitely lacking here. Just a lot of wood rot. After we fix that, then we'll put processes to make sure it doesn't happen again. So, and then resident engagement. I'll actually let in a second Bailey jump on that. And we'll just tell you a little bit about what we do. That's a big piece of who we are there. And then unit upgrades. We have interior renovations on the ones that haven't been done. Just changing out fixtures, lights, floors, and of course anything that's beyond cosmetics. And then our exit strategy, as I mentioned. Actually, go ahead, Bailey. Jump into kind of just talk on that resident piece there, and then we'll talk more about exit strategy.
Yeah, something that we've really honed in on as we've continued to take new acquisitions like here in Victoria and even expanding outside is just really what does it look like for the residents and how does it feel when someone is coming in and changing the management? At the end of the day, I think it's important to remember that these are people's homes and it's their lives. So we've really honed in on that takeover process. Within the first 30 days, we're coming in, we're making people feel comfortable, we're allowing them the opportunity to get to know us and who we are and what we do inside of Victoria. And that includes a lot of things, like welcome packages for the residents, Q&As on what's going to happen. How do you pay your rent? That can be really stressful to somebody who is an older resident who is always paid by a money order or a check. Or it can just be even stressful if you're managing a family and managing a life, when things are changing. So we really hone in on giving residents all the resources that we can upon takeover to make sure that their experience is comfortable. Within those first 30 days. And after we do that, we're really just dialing in on how do we keep the people who we, want to stay at the property. So we're offering resident incentives. We're throwing monthly resident events. We're offering resident referrals. Like if you love living here and we love having you, bring more people. So I think it's really just a part of the experience and the customization that kind of speaks just to who we are and our core values, like at Fergmar, of just about what's just important, to us and ensuring that we are creating that environment of, of calmness and kind of comfort within the residents at that part of takeover. So.
Yeah, very, very well said. I mean, our motto is enhancing communities through real estate, and this is that. Like, we want to make it look good. Don't get me wrong. We want great returns for our investors, but at the end of the day, taking care of the residents is exactly what does that. We have to take care of the property. It's just as important to take care of the residents. So, have the best shaped property and treat your residents like crap, and you'll lose them. So, both are very important to us. On the exit strategy, like I mentioned earlier, we're projecting a refinance in year 4. So that will be right towards the end of the assumable loan at that point. There's 6 years left on it, but the early payout starts to burn off, almost completely gone in year 4, going into 5. So that's when we'll execute the refi. Not to get too much in the weeds, but right now this is a small balance Fannie Mae, which has just the terms and the rates aren't as good. When we get into that year four, our NOI increases enough to where the value becomes high enough to where a loan amount can be higher than 6 million. Once you cross 6 million threshold, you're in the larger balance stuff, and you'll see better rates. For instance, today you'd see a low five on large balance versus low to mid sixes on small balance. So, and then we're projecting that refi to be at a higher rate than we could get it quoted on a large balance today. So pretty conservative there. And then at year 10, we would either sell the property or refinance again, which at a year 10, if we decided to continue holding, we would still hit the projected returns and then could continue to hold. Right now, we're projecting a 10-year exit. There's that. Sorry. Kind of here's the breakdown of the projected timeline. One thing we do that is a little different, we don't go in and start the work on day one. We used to, because our thought process was we'll go in and start just ripping things apart on day one, and everyone's just gonna feel great knowing that we're doing all this work to their property. Kind of outside looking in, sure. After, to Bailey's point, we survey these residents, we talk to them, they become family for us. They don't like the day one because everything's already uneasy. They have a new owner, they don't know what the new rules are, what are the rates going to be. Like you've just, again, that's their home. It may only be $895 out of a $104,000 gross potential rent, but that $895 is their home, and you've already disturbed it enough. So we don't do anything right when we go in there. Yes, it'll happen in that quarter, but it'll be a little bit of a probably 30, 45 day gap. So we go in, and our goal is, if there's a guy that has, a trash bag that likes to put, trash bag of beer cans on on the balcony. We don't allow that, but are we going to go in on day one or day two and just harp on him? No, we'll remind him of it. Now, tenants that aren't paying, yes, that's always the thing. You don't pay, that's a problem. You have to pay, but we'll be a little bit more lenient. We work with them, and then we just get acclimated to them knowing us over 4 to 6 weeks. And then we start the exterior work. As we start the exterior work and we start showing, hey, we're doing what we said we're going to do. At that time is when we start, you'll start seeing as leases turn, the rates go up. We start really just executing our business plan. And then that's when we start saying, okay, all right, kind of, we've already talked about the bags on your porch. Those have to go. Those have to go. And we'll be strategic about it, right? Like if we have 20 problem tenants, we don't want the 20 vacancies right there. We don't want to hurt the cash flow. So we're going to pick like the worst 2 to 5 bad apples, right? And then we'll turn them as we go. But kind of we'll go in, we'll replace the rotten wood, the carports. We're going to do all that. Interior upgrades. You'll see what happens into 26, and then interior upgrades kind of go into Q4 of 26, just because someone with a new 12-month lease, it takes a while to get them turned. Cost seg will happen right away, and then we'll immediately start working on other smaller repairs and upgrades. This is the unit mix. I think I touched on it, Bailey touched on it earlier, but we have 32 of our smaller one bedrooms, 32 of our larger one bedrooms, 24 of our two bedrooms. So out of the 104, only 16 of the 2 1s, which is great. Current market is 1106, and we're taking it to 1177. So the change in our overall market is not massive there, especially not for the amount of work we're doing to the exterior and some of the interiors. Kind of this is overview of financials. Again, I'm not going to read it line by line here, but this is, again, you either have this if you've clicked on the link, or we can share it with you. But like, our year one financials, where they sit now, is they're in the about 450,000 range, and we're projecting to be 403,000 NOI on year one. So we are projecting, with us putting money in, doing a better job at management, we're still projecting a loss, just to be overly conservative. The other thing I'll really point out there is, we focus a lot on economic occupancy. People say, what's the occupancy of the property? Oh, it's 95, it's 98. That's based on how many of the, out of it, if 95 of 100 are filled, I'm at 95 occupancy, but if 50 of 100 are paying, I'm at 50% economic occupancy. And really, that's, to me, it's what matters more. One thing you'll see here is that we never once project this above 88% economic occupancy. So, and Clayton, I don't know if you want to kind of touch a minute, just maybe, the past few deals, how this one varies, and when we did the underwriting, and the difference in how conservative this is, just based on the way the market's been.
Yeah, sure. So, I mean, first off, the initial top line numbers here with the comps in the area being, kind of unique, with the sense of, all rent, including all the utilities and everything, does present, kind of an interesting, challenge when you're trying to project the long-term revenue of the unit. So there's not a whole lot of those in Victoria. While we think that's unique, we also don't want to, bet everything on that. So we do have quite a bit of conservative numbers plugged in for the actual, rent growth over time. That just being one of the biggest factors there in terms of what we're looking for is also why we're hitting that economic occupancy so low. Most of our other complexes here locally, including the one right next door, is running at like 93, 94% economic occupancy. So the number could be much better than that. But again, it's not uncharted territory in Victoria, but it's also not something we're going to, stake everything on saying it's going to be identical. So we wanted to be a little more conservative there.
Yeah, and then one thing where the 88% is important too is, like you mentioned, we're 93, 94%. We have safe fells where our whole business plan from a property management standpoint changes at 90, so that we will see in kind of like World War III, this is, the house is on fire before it would happen internally, before it could even get to, or for when it gets to 90, before it could ever hit the 88. You want to just quickly touch on that, Bailey, like what happens in that standpoint to safeguard this?
Yeah, so I feel like it doesn't even really start like at the safeguard. It kind of starts on our day-to-day like operations and what processes we put in place like in order for our team to follow that. So we're very intentional like on accountability at Fergmar. On a weekly basis, my team tracks all their KPIs or metrics on a scorecard. Every single week, we meet as a department in order to discuss those scorecard metrics. If the scorecard number does not meet the metric, we're automatically moving it to a section called IDS, where we identify, discuss, and solve the problem in order to identify like where are we hurting in our communities, how can we help, are we having resident issues, is this an occupancy issue, a delinquency issue, where can we really dive in before we ever even get to the fail safe. It's happened very minimal times, but if we do get to the fail safe, then at 90% occupancy, if we're floating at that 91, 90%, all offices are automatically opening on Saturday. We're working extra hours. We're running specials. We're doing everything that we can in order to kind of boost those metrics and those numbers. But just keeping a weekly site and kind of that sightline basis during the week on that, I think is the most important before we ever even get to the fail safe. And we run every department at Fergmar here like that.
Thank you for that. Thank you both.
Yeah.
All right. Like I said, we can share this if someone wants more in depth. This is just the next page of that. Again, you can see we break down every year through 10. This is actually the overview of the yearly, and we break it down monthly, just get very granular with it. The investment process. So step one, review the offering, review the offering, the PPM, and all the other offering documents. If you haven't yet, if you clicked on this or you go to our website, fergmarcapital.com, if you're not signed up for the portal, you set up an account there. It's free to set up. We'll approve you. You can go in, you would review the deal. If you're interested, you make a commitment. It'll take you to the process where you complete the paperwork. You'll complete all the paperwork. It'll include your subscription agreement, PPM, operating agreements, a questionnaire about you. This being a 506C, it does have just to make sure that you're accredited investor. It's a simple process that goes through that. The portal's pretty advanced. They actually just recently upgraded, so some of this will be new to some of our existing investors. But you put all your information in, you wire your money through the portal, and then your distributions come back through the portal into your bank account. The way it works is we send out updates and distributions on a quarterly basis, and then all that's logged in the portal. So you log into your investment account, and you can see how your deal's doing, what your returns are, if you're in multiple deals, et cetera. And then the fund says wire funds, but it would process all through the system there. So that's kind of the overview there. And again, I'm always happy to answer additional questions. Our investment timeline, we went under contract March 28th. Due diligence ends. We have it as May 2nd right now, which is next week. Due to some delays on the seller's point, that'll probably get extended a little bit there, just because they've been slow to get us certain things we needed, not necessarily on their part, being an assumption, some of the lender contact details. And then we're in that June 26th. Actually, we're kind of projecting June 25th. So somewhere in that range, mid to end of June. So we will cut off investments at the earlier of when the deal fills up, which is currently subscribed at about 40%, I believe. So when that's full, or no later than probably June 1st. So from the time you make a commitment, we ask funds are sent within 5 business days or so. I understand that could vary for some. I've talked to some who are waiting on certain things to happen. So if that's the case, just reach out to me direct. And then here is our contact information there. So if anybody's interested, wants to learn more, There's the website, fergmorecapital.com. And then if you have my direct information, always feel free to reach out. Braden, do we have any questions in the queue there that have been put in so far?
Nothing yet. I was just going to kind of just close and just say, I think as this deal puts together internally, with it tagging on to our kind of current portfolio that we have in that area, and then just if everybody's not familiar with the area from a perspective of that oversupply that Austin and San Antonio and Houston are seeing, we feel really strong with not having that here, that we feel pretty strongly about Class B and even Class C kind of going forward. So I think a lot of stars are aligned for this one on this deal.
Okay,
Brian, I don't know if you saw that there's a message in chat there.
I got it. Okay, so I'll read through the whole thing, and then I'm gonna kind of macro break it down there. What is the trend on population growth in Victoria? What do you project in the next 5 years? What is your unemployment rate in Victoria? What do you see in terms of possible upcoming recessions? Do you think this will hurt your projections? Did you have to make concessions during COVID? So, population trend on growth in Victoria. Um, that's a tough one. It's minimal. We don't see large increases. We also don't really see the large dips. So it's a pretty steady. You could conservatively just go and say I'm going to use just a certain percentage year over year. We teeter totter on the city being in the mid 60s, county being in the 90s. What that doesn't factor is a lot of the surrounding counties. We do have some good things going for us now. A&M taking over there, the new Amazon facility that's being built. So we definitely have some things that will probably increase that. None of that is factored into our underwriting. We're factoring the same thing we've seen in this area, in this market, for the past, almost 20 years, one of those being through a recession. I don't have the unemployment rate memorized. If one of you guys have it, please jump in here in a second. I don't have it memorized off the top of my head. As far as recession, I'm not saying Victoria is definitely not recession resistant. I would say in this price point, being we're in that C going on to an A, going into a B possibly, with no new inventory coming online there. Even in the factor of a recession, we're just so diverse in the different job classes that we have. You have the chemical plants, we have the medical, we have the universities, now the Amazon facility, we have the large Caterpillar facility. There is not concern of that on this project at all. If we were talking about one of our retail centers, that would probably be a slightly different answer. So no, I don't think that hurts the projections. I also think we're extremely conservative there. So there would be room on it. If, as far as the concessions during COVID, Bailey, I don't know if you want to take that one, kind of what we went through during COVID and et cetera.
Yeah, so more so like mid to end of COVID, we really relied heavily on all of our local branches and then Texas grant programs. So something that was directly affiliated like within our department was the Texas Rent Relief Program. Other than offering concessions to tenants or writing off like bad debt, bad rent, what we did is we mass applied to these grants. So what the grant offered is that we would partner with the tenant in order to give them the resources that they needed. Like I said, whether that was a local grant or the Texas Rent Relief Program, and we would collect the funds in order for the tenant's rent. This was paying up to 4 to 8 months of the tenant's rent for them at times, as long as they were approved upon the Texas Rent Relief Program. And approval rates at that time were very, very high. So concessions were pretty low for us. We're hesitant to make concessions unless it's absolutely needed. So really, in situations like that, which I know it was one of the first ever, but situations like that, we really just like to rely heavily on like grant or resource programs in order to help assist us.
Yeah, and just touching on a little bit more again, and I think that's where just the operational experience comes in. I know COVID's a big one that has been factored in a lot. One thing that the past few years. We've even post COVID, just, pricing increases, insurance, taxes, those have all been things that have increased that's not that we didn't battle them. We've tried, but there are only so much that we could do or control there. And, a lot of people say, okay, well, you had a $50,000 tax increase. You're not going to fix that by saving money on a capacitor for a HVAC unit. We disagree with that. Like, you can save the 10 to 50,000 back, $2, $3, $5 at a time. And that's really where we focus on. Can we save 20 bucks on pool maintenance, on the chemicals? Can our guys do this on site? Bailey's been instrumental, and just recently we had one that we were battling that out on, and she shifted technicians around just because we needed to change that based on their wages fit better into this these units or this piece of the portfolio. So that is a huge piece of what we do. We don't just focus on the big numbers. You really got to dive into the little ones there. So next question.
I was going to say your unemployment rate right now is it's at 3.9%. So we're down about 80 basis points from about last July. So it's a pretty good trend in the right direction.
Thank you for that. What is the current economic vacancy for the property? Clayton, you want to take that one? Where are we sitting at? Do you know where they're sitting at now?
Sure. Yeah. Based on, there's two metrics we're looking at. So one, their actual T12s, their documents that they actually have in their offering actually have their market rent quite a bit lower than what they're currently getting. We didn't really want to look at it that way, so we did bump the market rent to what the market rent should be based on its current numbers. With that factor, it is about 77%. And that is mainly based on that market rate lost. Per their, actual documents they're submitting, they're showing to be 98, 99% based on their market rents. But again, it's vastly off from what they're actually collecting. So it's kind of a, thing we had to look at and step aside on.
Yeah. So to clarify a little bit on that, so when you talk about the economic occupancy, that's factored off of what you could produce. So if an apartment's renting for $700 and the market rate on it's $1,100, you have to factor in that, or let's just say it's $1,000 and you're getting 500. Well, that's 50% economic occupancy on that particular unit. What they had their market rates listed at was much lower than the true market rate. So in their eyes and their market rates, they're in the mid to high 90s and they think they're doing a great job, but that's also one of the reasons the property is not performing to its full potential. So the year one cost seg, so I'll have Clayton give that, but before he does, keep in mind, we'll do a cost seg. Right now, I think we're at 40% on that bonus. I think we're at 40% this year. There's been a lot of talk about that going back to 100%. Last time Trump was in office, we were at the 100%. So if that goes back, the number that Clayton's fixing to give would over double. But what are we showing there for year one cost seg, or year one depreciation, I should say?
In total, 481K. So for the average 100K investment, that's roughly $18,000.
So 18 per 100, if that could get closer to 40 per 100 you would get back. Can two accredited investors invest together at 25K each? Call me. Let's, it's 50,000 a share. We just have to talk about how you're wanting to do it. The key would be accredited investors. Outside of that, if we get to the 50, we could probably have a conversation, especially if it's the first one kind of getting in there. That's all I see in the chat room. Yeah, great question. So if anybody has it, please put them in there. I don't know if we had any that were submitted offline. I was just looking at that to see if we had anyone to put in that couldn't make it on the webinar. No. Okay. Look like we may have someone typing, so we'll give it, someone's off. Give it one more minute. Give it another minute, see if anyone puts anything up. But in a short, that's the project. If anyone wants to learn more or hear more, feel free, reach out, ask any questions. We're always here to answer them. And looks like we got a few people typing, so I'm going to give it one more minute here to see if anything comes through. Is there an opportunity in the future to separate the utilities? Yeah, sure. We could do that at any time. I don't see us doing that unless it is just giving us problems on the lease up, because it does make it unique for that property versus the other one. So we actually like that factor on it to separate it, because there's a lot of inventory in that area. So most of it's, even our other few hundred units, we're staying in that, 93, 94, even high 90s on some of the properties, but having that little bit of a competitive edge there is helpful. So we'll stay with it for now. Could we? Yes. Do we plan to? No, not at this time. Give it just a second. I see a few more popping through there. Uh, how does it compare to your other property size and class type? Very similar. Last year we brought on a 80 unit, very similar property. Uh, Most of the stuff is class C, going in, that we try to take to a B. Everything kind of in that Tanglewood area, I'd say, is the exact same class of what this will be when we're done. They could definitely get more in the unit count. We have a lot of 2 bedrooms. We have a 56 unit, about half the size, right around there. That's almost the baby brother or sister of this one. Um, but overall, I mean, I would say out of our 1,000 units, 80% of them are very, very similar to this. Again, that's why we like the utility thing. It gives it a little bit of I think even without the utility, this project could do great, but we love that competitive edge there. On the pro forma, what do you use for the exit cap? And join the call late. Can you tell me what the cap rate is at acquisitions? Exit cap is, we're at a 7. Clayton, what is that going in? I think we're 7.7, I believe.
Now we're actually like lower than that. We're 6.73. So we're shooting about 0.25 basis points higher on the exit, just for a little bit of safety margin.
Sorry, yeah, that's what I meant. 6.8 or whatever it was. Yeah, and it's important to note we're getting it quite a bit back of market. So I think our 7 cap exit is very, very conservative there. And we don't have this metric on there, but just talking about the purchase price there, we purchased a property last year. We're right at a year in. We hit into the 90s. We're approaching the end of our stabilization period. We bought that for 82,000 a door. We'll be in it around 90 a door, and it's doing really well at that. With an assumption that wasn't quite as good as this one, we are bringing this one on at 56K a unit, 78% LTV. So that's a big piece of where it's performing so well. All right. I do not see any other bubbles happening there. The bubbles tell me there's a question coming. I see no more bubbles. So again, looks like some have already hopped off, but appreciate everyone being on. If anyone has any other interest, or even if this deal is not for you and you have any feedback on it or just other thoughts, some of you I see names on here I've had lunch with, have calls with. I'd love to just visit about it, whether you're interested in investing or not, and talk to everyone. So again, appreciate y'all spending the last 45 minutes with us, and we'll talk to everyone soon. Have a good evening, and we will share this later on. Bye.
Thanks, guys.